5 houses and a condo.
Hey, there's a bubble.
How do you know?
Welcome to the Loonie Hour, the inaugural show here. Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice. So on the show today here, we've got the three amigos here. Myself, we've got Keith Dicker of IceCap Asset Management over in Halifax, been managing portfolios for over 30 years, wealth of information. And we got Richard Diaz, who is the founder and head of research at Acorn. Acorn provides bespoke consulting for institutional investors and family offices. Welcome to the show, gentlemen.
Hey, Steve. Hey, Rich. Let's get it going, guys. It's going to be a lot of fun.
We're gonna try to keep this light here for the first show. We're looking forward to the feedback here, but wanted to get in first and foremost to sort of the hot button topics. We're gonna kind of do a around the world scope here, and obviously bring it back to how this is going to impact Canadians. That's ultimately our focus here. But the number one topic that seems to be most discussed is ultimately inflation around the world running hot. I mean, our neighbors to the south there in the U.S., inflation just coming in at a 13-year high. So, CPI inflation ripping in at 5.4% in September. Certainly well above the Fed's target, and we know that Canada is probably not far behind. So, how are you guys, Keith? I mean, how are you interpreting the latest reading on CPI? I mean, is this transitory? Are we entering a new paradigm? What's your take?
Yeah, so a few months ago, I was clearly in the transitory camp, and the reason for that, you're looking at base year effects. A lot of the lockdowns, the supply chains, they were going to start to reopen. So for example, back in March when the 10-year was screaming higher, we were saying then, hey, like this is a good time to go long the long bond, and it would it'll sort of phase its way out, and that's what happened. However, what surprised me now is that the lockdowns are still continuing. The supply chains, they're not improving. It's just really difficult to get a global economy back up and running again after shutting it down. And, so like one thing that we always talk about, three of us, you say, it's not for us to say, hey, the policymakers should do this or should do that. But it's very clear when you shut down the global economy, you just can't switch it on very quickly again. So I'm now leaning more towards the camp where we got some pretty big problems coming up here. But just one more thing need to add to that.
So we're screwed then.
Well, I don't know about being screwed. I mean, for one thing, for example, markets, we're financial guys, right? So financial markets are never linear. They become exponential in both directions. So we'll talk about that with oil specifically in a few minutes. But, but trying to measure inflation from what we're seeing at the grocery store or, wherever you want to go to have fun, and then comparing that to what should be happening in some of the financial markets, you're going to get that wrong. Because it's never a mirror image of each other. Because if inflation really was screaming through the system, we should have long rates just go spiking higher. You're able to look at, for example, swap rates, 5 and 2 year. That's you get a good indication of what's happening. And for example, over the last couple of weeks, that's starting to scream higher. So that's indication we're going somewhere new. And then the other thing we'll talk about as well is, they might tie in what's happening with the Fed. A lot of people take things at face value, and we tend to be skeptical about a lot of things. But for example, there is a pretty big fight taking place right now between the Fed and Treasury, as well as the White House. And all of a sudden, you have some of the Fed members being scrutinized for personal trading. That's not a coincidence.
Rightly so.
There are some things taking place. But that's my quick view on where we're going.
Rich, chime in.
Yeah, so it's nice to be right every once in a while. So sorry to rub it in on the first episode, but I was of the view that it wasn't transitory. Told my clients as much. Obviously some of the inflation stuff is transitory. Used cars, for example, in the US or that kind of stuff. But I think Well, I mean, Keith touches on a couple of things that I think are really important. Number one is like what is being said and what is being kind of the message that's being kind of relayed from the Fed to everyone is one thing, and what is clearly taking place in people's wallets, in people's shopping baskets is another. And although you can't really people's anecdotal evidence is not to be relied upon. I think that one of the main things the reason that it's not transitory in my view, I think there's three really. Number one is the shelter component. So 42% of the CPI basket in the US is shelter. Shelter is basically where people live, housing, the cost of basically running your home. That's a function basically of often rental prices. There's a big survey. It's rather complicated, but basically more or less, if rents go up and the cost of house prices go up, then shelter component follows suit. And then that's, I think, one of the big problems is with this, with this kind of pandemic, you have a situation where that very, very important component just basically did not fall, which is much different than what happened in, let's say, 2001 or 2008. And functionally, that's a result of, there's many many reasons, but one of the two clear reasons is that there's just no supply. So if you look at months supply in housing, for example, or the vacancy rates of housing or rental units, so you can see, so really there's some upward pressure on one of the key components. And so, yes, there's going to be some stuff that's going to be transitory, like when the supply chains sort of unlock themselves. And as Keith pointed out, it's once you slow an economy down, it takes a long time to reheat. But there's some underlying kind of tailwinds there for that. And the other thing I think that's really important is the wage growth. Keith didn't mention that, but I think that wage growth, we'll talk about more of that later in coming podcasts. But I think that there's still loads and loads of people who have left the labor force. In the U.S., there was 95 million people not in the labor force before the pandemic, and now there's about 100. In Canada, even though Canada is back to its employment pre-pandemic, you still have loads of the participation rate still nowhere near what it was. And so I think that you have a combination of a few things that are really just going to keep pushing that lever. And back to Keith's point about, the messaging, I think the Fed needs inflation, but it can't admit that there is inflation. And so that's sort of my view.
How much of that is ultimately, I don't know. Like I find that, I'm following this inflation debate on Twitter, and there's a lot of smart people on both sides.
Yeah.
And, part of this debate is, everyone's trying to argue what causes inflation. Is it what's happening? Is it, M2 growing more than 20%, money supply, M2 growing more than 20%. Is it shipping containers? Or is it, a combination of, and how much of it is psychological? Because I don't know, for me, like I find it interesting. You start seeing the average person day to day that doesn't follow finance, doesn't follow macroeconomics, start complaining about higher prices at the butcher shop and higher prices to heat their home. Does it start to become self-fulfilling?
Expectations are really, really important, and that's much different than that's what we've seen before. Mario Draghi, the former ECB president, used to talk about that all the time. In inflation expectations over the euro area crisis, he always mentioned that whenever he had a speech. Always talk about inflation expectations. One way to look at it is, the Michigan consumer confidence survey. There's an inflation expectations component that refuses to fall. And when you get that kind of inflation expectation sort of entrenched in people, I think that's a really, really kind of different element than what we've seen in the past.
Keith, I got a question for you. So so my opinion anyways, I would love to hear your pushback on this perhaps, but is, I'm sitting there watching, whether it's the Fed or more recently, the Bank of Canada, Tiff Macklem comes out and says, it's transitory, we're confident, this is going to subside, it's going to be higher inflation till the end of this year. And then, we're going to get back onto track. Like, how much of that is just grandstanding to try to lower these expectations, to try to convince Canadians that he has inflation in the bottle?
Yeah, it's so I remember a long time ago when I took some investment courses, you learn about the tools of a central banker. so they can change the money supply, change interest rates. And then they had this other one, and it always struck me, it's called moral suasion. So it's basically, it's the BS indicator, they can talk and, they try to jawbone the market. And by market, people always think equities, but, we look at as, it can be interest rate markets, credit markets, currency, real, you name it. So they have to say that now. So it doesn't matter if it's the Canadians or the Brits or the Japanese, Americans, Europeans, they're all coordinated. So you don't listen to what they say, just sort of watch what they do. If they start to raise rates, all of a sudden it is just game over for so many sectors of the economy. So, we're Canadians, my house has doubled in value every month for the last 2 years. My house is $1 billion, so forth. But the point is, though, the moment rates start to go up, it's going to create an awful lot of stresses in the system. So sort of similar to, this global supply chain right now, it's creating stresses and then they build up, and the same thing will happen in the rate market. So I happen to believe that we will not see any central banks raise overnight rates. The only way that they'll do that is if they're starting to experience their own local, currency, stressful moment, so to speak. But otherwise, they'll do everything they can to keep overnight rates low. Because if they start to raise it, all of a sudden, funding costs at the federal government level, it just explodes. It's not linear, it's exponential. And then in Canada, it goes to the provincial level. Then at the banks.
You've written a lot about that, Keith, the provincial debt. And rightfully so, because I remember reading your report probably, I don't know, maybe a year ago. But during the onset of the pandemic, we actually saw that unfold where the Bank of Canada had to come out and start buying provincial debt to ultimately provide liquidity and suppress yield. So, is that one of those ones? Like, how do you see this ultimately playing out? Because I just look at it and say, are these guys almost, not like basically backed into this corner where, okay, we've got this inflation. It may not be transitory. It may not be transitory. We're shooting way above our target in terms of, targeting inflation. Do you raise, like, I just look at it and say, to me, it looks like you've got this higher inflation. The economy seems like maybe it's slowing down. Obviously, we know what's happening in China with Evergrande. It's the second largest, producing country. Do you tighten into a slowing global economy just to combat high inflation, or do you just let inflation basically continue to rip?
So I'll let Rich chime in a second here, but we're a big picture shop. That's what we do. You look for the big movements that are taking place, and I believe we are at the end of this long, 80-year cycle where it's the end of monetary and fiscal policy that everyone adopted after World War II. So Canadian economic policy, it's gone, it's dead. It's dead now for 12, 15 years. You will see every single central bank now, including the Bank of Canada, they are very active with promoting this, is going towards central bank digital currencies. So you have that happening. You're also hearing MMT being floated around. And then so central bankers, like, they're really struggling, guys. They have these, they got inflation going around everywhere. They're trying to do QE, they're trying to fund the deficit, for at the federal level here in Canada and elsewhere. They are preparing for a big shift taking place. Crypto is out there. That's pushing them as well. Financial markets are going to try to push them. But I think we have some big events coming up. So now I think the whole discussion about, inflation, is it too high, too low? Will they change rates to combat it? I sort of think that's looking at, the trees through the whole forest here. What do you think, Rich?
I'm a top-down guy too, and this is why I think you and I get along, Keith, and I think we'll have wonderful conversations going forward. For me, it's just a slightly different. I agree with you on the digital currency and MNT thing, so I'll just set that aside for a second. But the question of whether or not they're backed into a corner, I don't necessarily think that that's true. So I agree with Keith in the sense that they're not going to raise the short-term rates. And maybe it's more interesting if we disagree, and we'll have opportunities to do that some other time. But I totally agree with you on that. I think the key thing is, the Bank of Canada, just as an example, they have something called the preferred measure of core inflation. And this is what makes this TIFF, the TIFF's comments so rich, right? So delicious. He says, inflation is not transitory, et cetera, et cetera. And I think you have to like sort of jawbone that. And I don't blame him in a sense, because so this measure basically is, if you go on the Bank of Canada website and you look this up, it actually explicitly says the reason the Bank of Canada likes this measure is because it strips out all of the transitory or shock-related inflation stuff, right? So like literally they did this years ago. This series has been going on. The series goes back for 20 years. So they invented this thing. It's really smart, a bunch of PhDs in economics, smarter than I am, figure this out. They plot it, and it's already well above their target and rising. And so,
like, shit, we better change the basket again.
Yeah. Well, there's that, definitely that. But the idea that they're backed into a corner, I don't necessarily think so, because I think that they need inflation for all of this debt and deficits to get paid down. And I think we're in a situation. Steve, you and I have talked about this before, but I think it's a situation where 1940s to 1960s, where you basically had inflation running well above interest rates. And the dirty secret is that no one's ever going to get paid back in real terms. That's what this is why I don't necessarily think they're going to get back into a corner.
So you have a situation of basically deep, real negative interest rates for a prolonged period of time to slowly alleviate global debt to GDP, which sits at roughly 365%. Now, Keith, I've seen your comments on Twitter. I don't think you're as a huge proponent of yield curve control and how successful they might be. I'm kind of curious to hear your thoughts on how you see that playing out over the next, let's call it the next 5-10 years. As you rightfully said, the end of this Keynesian economics, which I think Ray Dalio also says, suggests is the end of this long-term debt super cycle. How do we get out of this?
Well, so first of all, inflation comes from three ways. You have excess, demand is greater than supply. That's what everybody wants. It means wages are going up. And then you can have inflation created because of a currency devaluation. So, for example, if your currency declines, everything's more expensive and so forth. That's not desirable as well. And then the other one, which is happening today, is that you have less supply. So supply is less than demand because, again, the global supply chain is shut down. So I think it's not... When we say hey, central banks, they want inflation, they do, but they want inflation with a healthy, normal economy with demand greater than supply. They do not want inflation because of a currency is out of whack. And I think that's where the next crisis will start and end. And they do not want inflation that's being driven by supply chain shutdowns. So that's just my quick thought on why. So we do not have a good inflation story right now today for central banks. They are not happy about this, so that's why they're trying to say, hey, it doesn't exist, it's gone, right? Something like that.
So the four stages.
Yeah.
Speaking
first,
of
it doesn't exist. First, it doesn't exist. Then it's stage 2 is it's a little bit less than you think it is. Stage 3 is that it's transitory, and then stage 4, which is going to come up, which is it's actually really good for everybody. Don't worry about it.
Yeah, so it's a good question. So go back to the yield curve control question, but just say we're the central banks, three of us. What can we do to reduce inflation right now? Joe Biden called the port authority the other day and told them to open up ports, and they're looking at us like,
you could raise rates. You could raise rates and tank the economy and push the economy into recession. That's one way to reduce.
That's
inflation.
what people seem to be advocating for in the Twitter sphere there. That yes, of course the Fed can do something about inflation. They should be hiking rates. And so I said, so you're basically saying is that they should intentionally push the economy back into recession to alleviate these inflation that will kill demand on the shipping side. That will fix some of those bottlenecks, but then your debt to GDP picture gets even worse.
It doesn't. Sorry, go ahead, Keith.
Well, another interest. So again, one thing I love about markets, you can dig deep and sideways and find things that most people don't see. So one movement that's happening today that I haven't seen many people talking about it, is the movement in you call it the Eurodollar market, or it's basically the cost of overnight financing. and which is representative of overnight rates. And over the last 3-5 days now, that market is indicating rates are going higher, and it's moved aggressively. Whereas at the same time, you have nothing from the Fed is indicating they're going to raise rates, none of that. So it's happening in the US, it's happening in the European market as well. So something is, afoot here underneath the market. So everyone, we all get excited with equity markets, and here in Canada, there's oil markets. People look at that. I do want to come back to oil before we finish today. But again, there's a lot of things happening right now. And one of the main drivers is always the Fed. And with the Treasury right now, with Yellen, they absolutely want to run this enormous budget. That's what they want to do. And they're getting pushback because, hey, the economy as well, the stock market is up, the Fed is pushed back against as well. So how do you get acceptance for a big budget to come through, more stimulus? Because as you said, we need some kind of a correction here in the market. And if the Fed is not willing to help or assist with that, then, hey, we'll remove you and get someone else to do your job. So, I suspect you're going to see a bunch of doves start taking over the Fed. And we're going to see enormous deficits going forward, some form of MMT going forward. But they need to set the stage first to allow that to happen. Because we have a big election coming up in the US next year with midterms. And, it's going to be it's going to be unbelievable what's going on with that election, how it can flip the House potentially as well as Senate. So there's going to be some pretty big moves coming up here. It's not as simple as people think it is all the time.
But Keith, you've laid out to me, we haven't really talked about our views on asset allocation, but one of the reasons I remain sort of bullish, although that has changed a little bit, I've become a little bit, thinking cash is probably where you want to be saved if you're trying to avoid a correction. But, MMT is to me the biggest bull, it's like, that's a hugely bullish thing, right? I mean, what you're doing is basically you continue to devalue currencies. MMT, modern monetary theory, for people who may or may not have heard that before, is basically what the Bank of Canada has done for the last 24 months, which is just print money to purchase deficits and debt, and in order to keep interest rates down, with the hook at the end of that, and the stick being in the future they're going to raise taxes. Now we all know that's politically basically unpalatable at this situation in this current environment. But MMT to me seems like an extremely really bullish thing for risk assets, because it's not that the risk assets are better or they're probably going to be worse, right? It's just that they're priced in real terms, right? So you have a situation where it's not that your house is worth more. It's that actually just your dollars are worth less and less. And so you don't have, and so to me that's like a really, really kind of people that. I think there's so many bears out there who are just like constantly trying to badger me and push back on like, well, why are you so bullish? I'm not bullish. I think it's the whole system is seizing and it's garbage. But at the end of the day, I want a real claim on the future cash flows, whatever they might be, rather than, let's say, bonds, which is, I think they're just totally bogus.
I think that's a good way to segue though, in terms of, okay, MMT in Canada, we've talked about inflation where, you're talking about a currency devaluation as well. This sort of stealth devaluation where you got higher inflation, you've got rapidly rising home prices, particularly here in Canada. Ironically enough, Tiff Macklem came out in his presser last week saying, the housing market is slowing down. So that's signs that it's transitory. And I can tell you from feet on the ground perspective, it is absolutely piping hot right now. House prices are still moving up and to the right, even though sales have slowed off of all-time record highs. But they are, so we've got the situation where you got, piping inflation, real negative interest rates. Looks like this cost of living crisis that you're suggesting. Okay, MMT is talking about higher taxes down the road. I mean, let's talk about oil now. Trading above $80 a barrel. I mean, how much does this chip away into the cost of living? I mean, I don't know, Rich, Keith, in terms of the cost of living, but also the cost just to heat your home this winter, which is going to be going up exponentially.
I mean, I can't speak really to the cost of heating a home. I don't live in a giant mansion like Keith does, with $1 billion house. So, my costs are actually fixed. So, and I rent. I'm a renter right now. I do. One of my clients is in England, London specifically, and he's a very, very wealthy man. And even he was squawking, and how can you blame him? His 40 or 60% of all energy in UK is natural gas, and his natural gas prices have gone up 5x. That's 5 times. So, I mean, I don't care how much money you make or have or whatever. I mean, that is an incredible, incredible amount. And it's what's fascinating is that loads and loads of natural gas providers have actually gone bankrupt, which I find also kind of fascinating. And the government there has had to step in. As far as its effect on cost of living, I mean, that's one of the bearish arguments, right? Eventually, the use of energy and oil is inelastic. You need to heat your house. You need to drive your car. I can't really speak to the housing crisis thing, so maybe I'll just step aside and let Keith take that one. But I think it is poking. I think what's really delicious in all this is, fossil fuels are dead, long live fossil fuels. I mean, we're all sort of facing the reality of how important fossil fuels are to everyone's livelihood, well-being. And I think that's something we've sort of been denying that and ignoring the cost of this green transition. And for me, it's been really kind of fun, really, in a sort of, a little bit of Schadenfreude watching this happen.
I think we're market guys. That's what we are first and foremost, and always when we're speaking all the time. And I think one thing that's really great about this current movement here in oil. So right now, if we shoot through, we're talking about WTI for oil, West Texas. If we shoot through 82, 83 range, like this can just scream higher. Like it could just go vertical, to the moon, so forth. However, one thing that's really great about these markets, nothing is linear. And that's my biggest observation all the time with markets. People think whatever happened last year will continue this year and so forth and whatever. And people have the shortest memories when it comes to investment markets. So for example, we'll come back to oil. I'll make a very good point with it. But over the last 20 years now, we've had 3 separate stock market events where markets have declined from, say, 40 to 50% in each one. So you got the tech bubble, the housing bubble, then the COVID pandemic. And the recovery time in each one, it's been shorter and shorter, but it takes a long time to get back from where you started when you get these events happening. But right now, today, with markets, it's risk on, especially in Canada. There's no risk anywhere elsewhere. But let me share with you what could cause a crisis or a stressful moment here in Canada. And again, we're always very consistent with this. It won't be a Canadian-made event. So I know we're going to talk another show about the BIS paper that came out. But if oil prices continue to scream higher, Canadians say, yeah, dollar's going higher, my house is going higher, foreigners are buying this and that because Canada's awesome. When oil and energy prices scream higher, it just sucks the life and soul out of other countries. So then you say, okay, which other countries are these? It's not the Americans. They have a lot of energy production inside. Parts of Europe have their own. It's not going to hurt the Russians. They're pretty good with it. Instead, you look at the emerging market space. And over the last 12 years, I'm talking about, and especially over the last 2 years now, or it was since the pandemic started, central banks, they've shut down price discovery in the bond market, as well with credit spreads. They're gushing liquidity everywhere. You think the one market that's wide open, that has exposure to any kind of stress or risk will come out, it is the emerging market space. So I know, Steve, we're looking at the Turkish Lira there just a couple of days ago. Again, this morning, it's at another all-time low, if you want to look at it, if you invert it properly. Turkey is in trouble. They have to basically import all of their energy prices. So every time oil is going higher, the Turks are saying, "Oh man, this is crazy. This is your friend in London. He's hurting with nat gas going higher. The Turks are hurting with oil going higher." But what makes Turkey even more vulnerable to everything is that they have no foreign currency reserves left. The central bank would say they have a gross level of about 80 billion. Most of that they've actually taken from the commercial banks. So if you have a US dollar deposit at a Turkish bank, you think it's safe. No way. The Turkish central bank, they've taken it, repossessed it. They're using it to sell dollars and buy lira on the open market. So, I mean, they're down to about maybe 20 billion right now. And they have about their trade deficit. It's about 60% of it is related to energy. So again, they're in real trouble here. So the longer you have oil doing this, the tighter it just grinds everyone. One of the best trades I've ever been involved with, and I know I'm wrong, but this is really, people like money, right? But one of the best trades I've ever been involved with was when oil spiked up to about 146, 147. I think it was 08 or 07. I forget the year it was exactly. It was going straight up. And everyone then was saying, hey, it's going to 200. No, it's going to 250 and whatever. A lot of the models we had at the time say, hey, this has gone vertical, sentiment is sky high. This is going to flip over here. And I think we are going to enter that. It's my hope that energy does scream higher, specifically oil, because then we're set up then for one of the biggest trades we've seen in our lifetime is to short oil. I don't think it's right now because when we have some support levels, it might hold here. But if it does start to scream higher, everyone's going to start tumbling into that trade, and boy, you get on the other side of it.
Keith, I just wanted to circle back on that because I know there's going to be some listeners here, you know, some good Canadians listening here, and they're going to say, "Well, Keith, the hell do I care about Turkey? What are you talking about? Higher oil prices impacting Turkey? Do you want to explain that correlation? Because we were, you know, getting back to a crisis in Canada, it won't be homegrown. It won't be Tiff Macklem gets a spine and decides to normalize interest rates. It'll be, overseas. And your view is in Turkey. Do you want to explain that correlation?
Yeah, absolutely. Yeah, that's a great point. So if Turkey runs into problems, then you have to say who has direct exposure to Turkey, and you're looking at Spanish banks. So not big, but and then which spills over to the French and the German banks and. Don't even get into the Italian banks. And they have they live in their own fantasy. By the way, I like to call Europe the economic fantasy land called Europe because there's that's another conversation. But the challenge here with someone like Turkey, if they do run into a crisis event, which they already are, Erdogan continues to fire and reshuffle the deck at the central bank every month. It seems like you have the opportunity for contagion. And people would say, well, there's no direct link. You do not need a direct link. You can have an indirect link. And people have made a lot of money over the last 18, 20 months now. You just need any excuse to start taking risk off the table. If it comes out of Turkey first, all of a sudden, other emerging markets, Brazil, Mexico, South Africa, you name it. It can spill over very quickly, Steve. And then the way that affects Canada, and this comes back to yield curve control, whereas you will not have overnight rates going higher, you can have credit spreads start to widen dramatically, which is mortgage rates here in Canada. And on top of that, just long-term nominal rates can start screaming higher. So it can happen very quickly, and it comes down to the banking level as well. And again, that's something that comes out of, people say, oh, that's left field, that's not going to happen. That's where the risk is. That's where something is set up here to happen, because again, nothing is linear in the investment world. Everything goes exponential, back and forth, or up and down. And I just think we're set up here for
how much weight are you guys putting on China Evergrande? Because there's five developers now, 5 large developers that have now missed a payment or have delayed a coupon payment.
There's never just one cockroach. So when I heard about the Evergrande thing, it's the same with all these sort of crises. I'm sure that Canadians will eventually reckon with their own real estate crisis one day. But I think that the China thing, is a different story. I think China's got it. China, next year is, I think, the 20th, party Congress. Xi Jinping is in the middle of setting up for a third term, which is not unprecedented in China, but is very, very rare, and was was illegal for a long time. And I think China is a different animal just because of how powerful that totalitarian regime is, and I don't think that necessarily want to get sunk by a couple of real estate companies. The other thing I think is also really important to note is that China, although they ran huge budget deficits, they have really, really high real interest rates, unlike most of the Western world. And they have a lot of room on the monetary policy front. Unlike Canada, which bought basically all of the government bond issuance over the last 2 years, or the US, which bought about 50, or Europe that bought 80% of it. China's actually cut down their central bank assets as a percentage of GDP. I think it's at a 20-year low. Their central bank assets have basically been flat for a long time. And so they have a lot more room. Now, I don't know, Keith probably can speak better to how the market would react if this continued. But as far as specifically, would China, drive into the ditch because, half a dozen other real estate companies, I'm of the view that they can definitely weather that storm. They have a positive current account balance, huge reserves. Their currency is at a high. They can tank that. I just think it's a different animal. But one more thing on the oil thing, and related to Keith's point about the contagion thing, is and your point, Steve, about raising short-term interest rates. I mean, loads of emerging markets have already started to raise interest rates, and a function because they don't have the luxury that a lot of Western countries, the euro, all these hard currencies. I mean, we get on, Canada and the US and euro, they're hard currencies and they live on a hope and a prayer. But I mean, Brazil has raised interest rates 600 basis points. And, there's a bunch of other of these countries. And so when you think about oil going up, you think of, the pressures that somebody like, whether it's Brazil or another emerging market, they're under a lot of pressure.
You used to live in the UK.
Yeah.
The Bank of England is coming out and saying that they might hike interest rates, I think, before the end of this year is up. At least that's what they're saying. Was that just a bunch of, hot verbiage that they're trying to sort of quell markets, or what's your take?
No, the UK is in a really, really tough position. I mean, UK has a huge current account deficit. They're dealing with this. They've gone all in on the green stuff. So they're importing massive amounts of energy. And I think they're in a really, really difficult position. But I think also, and then you have a situation where, the market, like, you aren't having anywhere near the same kind of sort of portfolio inflows that you have. So the other side of your current account is what's known as a capital account. And so for years they generate a lot of revenue and income from Europe and other parts of the world, and that's sort of gone down quite a bit. And so UK, I mean, is going to have to deal with that. And I think you can see why its currencies really hasn't done as well as it necessarily should. And it's also got a really kind of just an absolute shit equity market. It's just not positioned the way. I mean, if you look at it, has massively underweight tech, and its banks are really exposed to a lot of the European banks, and so you're in a situation. And so it's just, and its healthcare has underperformed. I mean, it's just not a really great place to invest. Other than, people, somebody from Kuwait trying to hide their money in London or something like that. It's been an absolute nightmare. I think UK has underperformed for the last 20 odd years relative to the global equity market. So I just see more of that.
So Rich, with your bit of a bearish / negative observation on Britain, it's making you sound a little English yourself.
Yeah, I'm afraid so. I mean, I love England. It's a great place for beers. I mean, at least you can drink beers outside like a civilized person. I think you're right, Steve. I think a lot of it's jawboning, but I don't know how you can as a central bank raise interest rates into a situation where you're having energy crisis. I think that's just people just won't stand for it, right? I mean, I don't know how you could sort of do that.
You're going to raise our interest payments, our debt servicing costs, while the cost of energy to heat your homes is going up, like you said, 5x.
Yeah. It's not just that, right? It's like, shrinkflation. I mean, we're sort of going around, we're coming back to where we started, but I think it's like, shrinkflation is a thing. If you go on, there's like a subreddit on Reddit called Shrinkflation, which is like amazing, where people just take photos of products they used to buy, and you can say, well, Rich, it's anecdotal and you shouldn't pay it. I think that's exactly what the fact that people are thinking and talking about it affects people's expectations, something you said earlier, Steve. But also, you can't deny it. I mean, people, it's instead of getting 30 rolls of toilet paper, you get 28. It's like
we're down to single ply now.
Yeah.
Except for Keith. He's got triple ply still. in his mansion.
But
Keith, do you have any final thoughts to wrap up the inaugural show here?
Me?
Yeah, you.
Oh.
You're still thinking about that triple play.
Yeah, no, I was just thinking about the whole. I think we're going to have a lot of fun, really great conversations going forward, and we really welcome people tuning in and watching and listening. I know we had a bunch of questions come through over Twitter, and I think we touched on some of them, sort of off and on. And I saw one that came in a while ago. It's kind of interesting. It says, "How does Steve Saretsky always have 3-day shadow? Never 4-day, never 2-day. It's always 3. How does he do it all the time?"
That's a good question. There's no science to it. I only have one setting on my razor. It's 3-day shadow. But speaking of which, we'll end it on a final question. We actually also got another question from Connor Damone that's asking, "What's your favorite donaire shop in Halifax?"
I know Rich loves donaires. So
no, I absolutely hate donaire, so I will abstain. But Keith, you've lived here a long, long time. I'm sure you know a good one. I mean, shawarma is beautiful. Middle Eastern food is fantastic, and to go and adulterate it with sweet whatever that is I don't know. I can't do it.
For anyone that doesn't know,
I'd rather buy ESG funds than eat a donaire. Let's just say that.
Wow, that's a bold statement to end it. I love it. Just to wrap this up, final comments here for those who aren't aware. So Keith and I actually got acquainted, I don't know, maybe a year and a half ago. Keith, I actually discovered Keith initially. Someone sent me his ice cap reports, which Keith, I don't know, you think you put them out like once every couple months, but you just posted a new one. So if anyone's interested in checking that out, and I think Rich is helping with some of the data analysis and some of those, but really good wealth of information. Keith was it's icecapassetmanagement.com, I think, and it's pretty easy to find there. So, All right, gents. Well, let's wrap it up. We'll wrap it up here for the first ever show. Listeners here, we're looking for feedback here. We're trying to keep this lighthearted, a little bit loose on structure here, but bear with us, give us the benefit of the doubt, and we'll continue to pump these out on a weekly basis. So thanks for tuning in.
Thank you.
Thanks, guys. Bye-bye.
Cheers, guys. Cheers.